Okay, good evening, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or yes there, just to let me know that it is indeed working. I hope everybody's having a fantastic evening so far. I'm looking forward to talking about our COT report tonight and kind of going over the strategy, how it works, and in addition to that, going over kind of the results of it and how you can go about trading it this coming week. So looking forward to getting into it right now. Just to introduce myself for those that are new or watching this in the recording, my name is Steve Perry, and I run tradingwithsteve.com. And so if you're interested in learning more about what we do and the services that we offer, there's a link in the description down below where you can learn more about the COT report and learn more about my services, the trading services that I offer. So before we get started, though, as always, I need to go over the disclaimer. You can lose all or more than your initial position if you're not careful. So please be aware of how many pips you're risking on each trade. In addition, how big your lot size is, and ultimately how that would affect your account if you're to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys, so let's talk about what the COT report is first, and then we'll get into how the strategy works, the results of the strategy, and then the last thing that I want to do at the end is kind of set you up on how you can go about taking trades with the COT report this next coming week. So let's dive into it. So first of all, COT is an acronym and it stands for Commitment of Traders. And it is a report that's released by the government. So if you go to cftc.gov, this is the government's website where they create and release the COT report. Okay, so cftc.gov is where you want to go. They have this ribbon up here where they have a lot of different things. The one where it says market data and economic analysis is where we want to go. And below that, there's a drop down. There's a lot of different things on here, tons of different data. The one that we look at is this one that says commitment of traders, which is for COT, and we click on that. Okay, and then this is basically the home for the COT report, and there's actually several different COT reports that are released. There's COT reports released for agriculture, COT reports for petroleum, natural gas, electricity, metals, Forex, and they're also released by legacy reports. These are different exchanges that report their own COT reports on their exchange. It's actually a pretty comprehensive thing. Now, for those that don't know, basically the COT report tells us what positions outstanding are long and what positions outstanding are short on any particular asset or instrument that's monitored by the CFTC. Okay, so the CFTC monitors different institutions that are on different exchanges. The exchange that we typically look at is Chicago Mercantile Exchange, or the CME, right? And they have their own COT report down here. You can see it. We typically look at the short format of the Chicago Mercantile Exchange when we're looking at non-commercial data, and when we're looking at leveraged fund data, I usually look at this financial legacy report, and they only have a log format for that too, which we'll take a look at both. But basically, this is where you find everything about the COT report, and you can learn more about it if you just come to this page. You can click on this show introduction. There is information about the types of reports, which I highly recommend that each one of you reads at least once, just to get an idea of the different types of reports, because there are tons of different reports. Like when you're looking at futures, it's segregated into 4 different categories, and it's important to understand which category does what, because each category trades for different purposes, right? And we want to trade with the category that is most aligned with a currency trader or somebody like us who's looking to take advantage of day-to-day movements or week-to-week movements in the market, right? I specifically look at two different classifications. So I look at the leveraged funds in this one right here in the financial futures report. This is the one that I've actually used for several years. Okay. So for the last, I don't know, maybe 3 or 4 years, I've always gone to leveraged funds. And but the other one is not the non-commercial, which is found on the short format of the Chicago Mercantile Exchange. And I think they even, let me see if I do a Control F, search non-commercial. I wonder if that, yeah, here it is. So non-commercial. Yeah, if you read this, it says legacy. The legacy reports are broken down by exchange. These reports have futures only report and combined futures and options report. Legacy reports break down the reportable open interest positions into two classifications, non-commercial and commercial. Okay. Basically, in a nutshell, non-commercial are large speculators. These are companies and banks and institutions that specifically buy and sell these financial instruments for the purpose and the purpose of alone of making money, right? Commercials are usually professional hedgers. These are companies that go out, specifically very large companies that have a lot of inventory on their books, both in currency and from whatever they sell. These are usually companies that are multinational corporations, and they require to have positions in different currencies all over the world, right? So sometimes what a commercial trader might do is when they're buying and selling product, and there's, doing a cross-border transaction in different currencies, they may buy or sell another currency to offset any potential losses during that exchange or transaction, because some of these transactions can take several months, sometimes even years to take place, especially like, let's say you're a company like Toyota and you're selling your cars to another country. And during that time that you're making that transaction, the currency of the other country might go up or down and fluctuate. So in order to offset any potential losses, you can buy or sell the other country's currency to offset that. And that's what commercial traders do. They often are on the wrong side of the market because they're essentially hedging their position. Okay. So we don't usually want to follow commercial traders. We really do want to follow the non-commercial side. There will be times when the commercial side gets it right and vice versa, but in general, non-commercial is the side we want to follow. Additionally, when you're looking at these reports, so let's read number 4 here. So number 4 says traders and financial futures. It says the traders and financial futures, or TFF, report includes financial contracts such as currencies, U.S. Treasury securities, euro dollars, stocks, VIX, Bloomberg Commodity Index. These reports have a futures only report and combined futures options report. The TFF report breaks down the reportable open positions into 4 classifications. Okay. And from what I've found and what I've studied, it's the leveraged funds you want to follow when you're reading this particular report. And if you click on the explanatory notes, which is right here, which I'd also recommend that you read when you get some time, this is kind of nice. So let me pull this up here, give it a second. And by the way, for those of you live or watching this in the recording, let me give you the link to the COT report. Actually, I'll do that in just a second. But when you're in here, this is actually a really nice breakdown. If you're really going to get into the COT report, I mean, I would read anything and everything that you could potentially read about the COT report, which, by the way, that reminds me, COT reports have been around for many, many decades. So this isn't like a new thing in the industry. This is something that's been around for a long time. The CFTC specifically has been releasing their COT report since 2005. So it's coming up on 2 decades here in the next couple of years. But yeah, that's just to give you some information about COT reports. It's pretty cool. Okay, so when you read this and you come down to view the different classifications, like I said, there's the dealer side, asset manager side, and the leveraged fund side. And there's also other reportables, but we focus on leveraged funds. Let's read that real quick. So it says, these are typically hedge funds and various types of money managers, including registered commodity trading advisors, CTAs, registered commodity pool operators, CPOs, or unregistered funds identified by CFTC. The strategies may involve taking outright positions, which, by the way, is a financial term, outright positions or arbitrage within and across markets. The traders may be engaged in managing and conducting proprietary futures, trading, and trading on behalf of speculative clients. So that's a key word right there. So when you hear the word speculative, these are groups of people and or corporations, banks, institutions, just anybody that's under this umbrella who are clients that takes outright positions, and they're speculative clients. And the reason why that's a key word is because we're kind of like that too. We're speculating, we're speculating all the time. Is the euro going to go up? Is the euro going to go down? Is the Japanese yen going to go up, or is the pound going to go up or down? Right? We're always trying to figure out which way the market's going to go, because if we can figure out which way the market's going to go, we can then apply a trade, execute a position, and we can make money off of that, right? So we're kind of speculators, absolutely, right? And these guys are speculators, and these guys are really good at it. These guys make money, and they're doing all the work for us, which is kind of nice. And we just get to kind of monitor their moves and respond to their movements, which is really, really nice. Okay. So anyway, that's what we look at when we're looking at the COT report. Let me go back, and then I'll give you this link for those that want it in the chat box. And if you're watching this in the recording, you may or may not be able to grab that link. If not, just shoot me an email, steve@tradingwithsteve.com, and I can get it to you. Okay, so first of all, let's jump in, or I guess next of all, let's jump into, let's look at what a report looks like. Okay, so there's really just two reports I look at. It's this one right here, long format of the financial report, and then I look at the short format of the Chicago Mercantile Exchange. Okay, so let's look at this one right here. When you look at this, the report is super boring. It looks just like this, okay? And it's always going to be dated on Tuesday, and it's always going to be the last Tuesday from the previous week, okay? So the way this works is these institutions who are on these exchanges, who report to these exchanges, they are required to submit their positions by end of day Tuesday every week, okay? And then the government, the CFTC.gov, takes until Friday to release this information, okay? So there is some delay, and I do want to make sure that that is clear, that there is some delay to this information. It's not a game changer, but I do want to make sure that that's clear when you are looking at the COT report, that it is not something where you're privy to this information the moment things are happening. But nonetheless, the context of the COT report, even though it's delayed to some extent, is still worthwhile, and there's still plenty of strategies that can be formulated that you can make money with using the COT report. Absolutely, 100%. There's valuable information that you can extract from the COT report every week. So then it's released on Friday at 4 p.m. Eastern after the market closes. So you couldn't use it on Friday, even though it's released Friday, because the market will already be closed by the time this is released. So typically what I do is I take this information on either Friday or Saturday or Sunday, and I formulate it into my COT report journal, which I'll give to you guys if you don't already have it. And then I essentially just determine which direction I want to go. And I'm going to explain all of those details in just a moment, like how I define which direction we should go based off of this information. I'm getting to that point in just a moment, but that's when I put it all together, is on the weekend. And then it's all ready to go. And then on either Sunday or Monday, when the market opens, you can go ahead and start actually applying trades and executing trades based off of this information. which is really, really cool. And this week has been a really good week with the COT report. We've had a lot of great trades that are doing very well. We've had a lot of trailing stops move up, and we've mitigated a lot of risk. And so far, looks like it's going to end profitable. It's been a good week so far. And we'll talk about those results in just a moment. But this is what a COT report looks like. And it's always going to be dated the previous Tuesday. So this one says May 9th. That was over a week ago. And there is a new COT report in the makes right now. So as of yesterday, these firms would have needed to report to the CFTC their new positions. And this Friday, we're going to find out, okay, what those are, right? And we'll get a new COT report in the next 2 days. All right. So this information is starting to get a little bit old, but it's still useful, definitely still useful. Okay, so when I'm looking at this, again, we've already talked about how it's segregated into different categories. You got the dealer side, you have the asset manager side, leverage fund, other reportables, and there's also non-reportables. We've already concluded that we need to follow the leverage fund side because this is the side that trades on behalf of speculative clients who are trying to take what we call outright positions. Okay, they're taking outright positions for the sole purpose of making money, and that's it. Okay, so when I'm using this, I like to zoom in because it's hard to see when you're zoomed out. So you can just do Control plus on your computer and zoom in, and you can zoom out with Control minus. Okay, and then I do a Control F to search what I want to find. So if I want to find the Australian dollar, I just search AUD, and that's going to take me straight to the Australian dollar, which is right here. Okay, you can see the Australian dollar on the Chicago Mercantile Exchange, and this is all represented by 100,000 contracts. So a single unit is 100,000 contracts. So when you look at these numbers, you have the long side and you have the short side, right? And right here, you can see there's 29,226,000 contracts long on the Aussie versus their 35,313 contracts short, right? So basically, these are, so if you're looking at this information, you can see that there are more outstanding positions on the short side than there are on the long side. So that is important information to consider when you're trying to take a trade with the COT report. But the most important thing, and we're going to talk about this later, is the change in positions. So we want to find out if they're adding to their long side, adding to their short side, or both, right? Because that's very valuable. So the next thing you can look at is just below that, you can see the decrease in positions versus the decrease in long positions, which was a big decrease from the previous week. You can see that right here. There was a big drop off in Aussie positions and a fairly large increase. Well, I would say just decent increase to the short side. So they're definitely adding to their shorts, taking away their longs, right? That's information that's very valuable because that can help you determine what your bias is going to be in the upcoming week, because these are professional money managers who take outright positions for their speculative clients. And our job is to basically try to follow what they're doing, mimic what they're doing. And if you can use your other systems and strategies in addition to this, it's very, very valuable. Okay. Okay. Great. And Lee says, do you think we could go over how to manage your COT report trades? Never use a trailing stop, so I'm a bit unsure how to manage the trades during the week. Yeah, for sure. We can absolutely cover that in just a moment. Let me kind of get through what I was going through here, and then we'll get to that part as well. Okay, so if you wanted to look up another currency, like if you wanted to do another Control F, you could search whatever else you want to search for, like the euro. We look at the euro. Make sure when you're looking up the euro, don't look at euro dollars. That's not the euro. That's something totally different. Okay. So make sure that you pull that up specifically. This is what you want to see is Euro FX. So these are Euro futures on the Chicago Mercantile Exchange. And then again, make sure you're looking at leveraged funds, the long side and the short side. And then you want to look at the change in positions. Right now, on the leveraged fund side, they've added a significant amount of longs and shorts. A little more shorts than longs, but they are definitely starting to increase their to their short side, which is something that we've been talking about all week. We don't need to go into all those details right now, but it is interesting to see. Okay, that's kind of how you navigate the report. Now, not if you're just going to use my journal, you don't even need to do this, but I do know a lot of you, and I think it's important. A lot of people don't want to be reliant on somebody else's journal or somebody else's signals, and I totally get it. That's why I'm teaching you how to find this information on your own if this is something you want to do. I actually have a client who built an Excel macro that could, and maybe some of you are pretty smart this way, where he was able to extract this information every single week from the COT report with just a click of a button, a single button, which is really, really cool. Really, really cool. Anyway, okay, so that's how you navigate the report. The next thing that I do is I go over to I come over to my journal, and in my journal here, I keep track of my week-to-week progress. Okay, so there's a lot of information here, and I want to show you how to look at this when you're looking at my journal, which, by the way, for those that want this, I'll put this in the chat box. This is just my COT report journal. Let me show you how to read this. So when you read this, I've kind of segregated this into two different categories. There's the current holding side, and then there's the shift in positions. Okay, so we've already talked about how the banks can have these positions currently, but we've also talked about the importance in their shift in positions. So the direction in which they're going is often more important than even the current holdings, which is something I need to do more research with, because a lot of the trading that I've done over the last several years has been based off of just simply their current holdings. And it's worked out really well for me. I've done very well just trading off of their current holdings, but I'm always trying to find ways to improve the strategy. And I'm doing that by researching and backtesting the shift in positions. Okay. So also, when you look at this, I've got 8 different currencies lined up here, not currency pairs. These are just currencies because we're isolating how the Aussie is doing specifically, how the euro is doing, how the pound is doing. And we're just isolating single currencies and then deciding which currency pairs we want to trade this coming week or next week. Okay, and I've got the date also here. This information right here comes directly from the COT report. Also, this information comes from the COT report. This information right here, these 3 columns are derivatives of whatever I inserted right here. So this is the percent long of all the positions outstanding. This is the percent long, and of all positions outstanding, these are the percent short for each currency. Okay, which is very important information to look at. This information right here, these 2 columns come from the COT report. So it shows you the change from week to week. This is the long change versus short change. And then this is the net change in contracts. And then this next one is the percent net change as a function of or as a derivative of total positions. Okay, so like when you click on this, it's basically just taking the net change and dividing it by the sum of contracts, multiplying by 100, and that gives you a percent net change. So you can see what things have changed the most. So for example, we talked about how the Aussie's seen a really big net change to the downside. So the Aussie is weakening very quickly. The dollar has strengthened significantly from the previous week. You can see other ones like the pound has weakened significantly. What else is weakened? A lot of stuff is weakened, just not necessarily significantly. So that's also really nice information to see. Okay. The way I've traded this for years, and this has worked very, very well for me. And again, I'm always open to trading this in other ways. But I think it's important to trade the strategy based off of what has worked and what you know, right? So even though I guarantee there's better ways to trade the COT report, I guarantee it. In fact, many of you will probably find even better ways to trade the COT report. The way that's worked for me the longest, which goes a long ways, something that's been consistent for years, and has been kind of that golden goose that just keeps producing, even though it may not be the prettiest golden goose, but it works. I think, again, like I said, it goes a long ways, right? So the way I've done this and the way I determine, and I'm sad he's not here. I don't see him in the live webinar. Maybe he'll show up later, but I had a client ask me this afternoon, how do I determine what are the top 6 trades a week that I take? How do I figure that out? I'm going to show you exactly how I figure that out. So once I've made a new entry on the weekend with the top 6 trades to take, or excuse me, before I even get to that, once I've made a new entry of the information, then comes the fun part. The fun part is being able to analyze this information and then decide which one is going to be which currencies and currency pairs you're going to trade. So the way this works is I direct my attention to these 2 columns right here. It's the percent long and the percent short. And what I do is I just try to highlight the top 2 or top 3, depending on how long everything is, the top 2 or 3 most bought currencies as a percentage. And I also like to highlight the top 2 or 3 currencies that are short as a percentage. It just so happens that for the last several months, there's been basically mostly shorted currency pairs or current currencies. There's a few currencies that are bought up right now, but there's mostly currencies that are sold. And so that's why I've picked 3 on this side as the most sold currencies. And I've only got 2 currencies over here that are pretty bought up, right? If I had currencies that were, another currency that, let's say, it was 60, 70% bought up and only 20, 30, 40% sold, maybe I'd add another one to the long side, but I just don't have a lot of currencies right now that are bought. Mostly everything's just sold right now. Okay, so with that in mind, I'm just picking the top 2 or top 3 on each side. Okay, so this last week, the Kiwi was a big winner, right? It had, well, I guess even before the Kiwi, the dollar was a big winner. Dollar was 65% long. So when you look at the total positions outstanding on the dollar, and you have, there's 20,000 contracts outstanding and there's 13,000 long, that's actually a pretty good percentage. I mean, that's 65% of all positions on the dollar are long, right? So that's actually pretty significant, especially when you look at the change from the previous week. So long on the dollar makes a lot of sense right now. And then what also makes a lot of sense is the Kiwi. So the Kiwi has been a very bought up currency relative to other currencies right now. It's only 55% long and 55 to 45%, 55% long and 45% short, but it is a very bought up currency nonetheless relative to the other ones. So that's why the Kiwi was a winner. And that's why we've been buying the Kiwi the last couple of weeks, is just because it's been one of the big winners. Okay. And then you look at the short side, the yen has been a loser. 72, 73% short. The franc is also a loser, at 61% short, and the CAD is almost 60% short. So when you look at this, what you want to do is you want to pin the strongest currency against the weakest currency. And To be honest, and I think for those of you that are watching this for the first time, whether that's on YouTube, really ask yourself this question. Maybe this is something, a concept you've never even thought of before. But I get this question from a lot of people who come to Forex for the first time. Maybe they were trading stocks, maybe they were trading futures or options. When they hear about currencies, they're always intrigued by the concept of trading in pairs, right? Because whenever we buy or sell the euro, you can't just buy the euro. You have to buy the euro with something. If you want to sell the euro, you have to sell the euro with something, right? So that's why we trade currency in pairs. So you're basically buying the euro against the dollar, or buying the euro against the CAD, or the euro against the pound, right? Or whatever it is that you want to buy or sell. You have to pick, how am I going to buy the euro or the pound or the yen? How am I going to buy this? And you have to choose what currency you want to buy it in. Okay. And so now that you're doing this and you're isolating individual currencies, and then you're the one deciding what are the pairs you're going to trade in the coming week, that is the essence of currency trading, if you think about it, because that's how currencies were designed to be traded when they were created in the very beginning. Because you're trying to isolate, okay, this currency is doing this other currency is doing this, so I should probably trade this pair, right? So this is kind of a fun part, because you're the one who gets to design the pair and then the subsequent direction that you're going to go, which is really, really cool. So when I look at this, I see the most long currency is the dollar, and then the most sold currency as the yen. So when I see that, something with the dollar and the yen would make the most sense. So that's the dollar yen currency pair. And we would look for a long position, because you're essentially buying the base currency and selling the quote currency. Okay. Next one up, you see maybe the dollar against the franc would be a good option. So buying the dollar against the franc would be good. The next one up would be dollar against CAD, and that's why it's number 3. And then you have 4, 5, and 6, which is basically buying New Zealand dollars against the yen, or buying New Zealand dollars against the franc or the CAD. And that's how we were able to formulate the top 6 currency pairs this week. One second, let me just go ahead and close my blinds here. Sun's kind of in my face. Okay, so now I had a person ask me, I think it was yesterday or a couple days ago, in one of my live trading webinars. He said, why is it that you're only trading long? Why are you only buying? And I'll be honest, it is coincidental. It may not seem coincidental. It is coincidental. And it's been long for a long time. Like, we've had a lot of long, there hasn't been a short opportunity, I think since January. Yeah, January was the last time we went short on something, which is kind of crazy to be honest. But it is coincidental, because it just so happens to be the way these currencies have lined up. So it just so happens with the Kiwi, most of the time the Kiwi is the base currency. So the New Zealand dollar is the base currency, and it just so happens that the dollar often is the base currency, and so that's why we've gone long on everything. We had some trades on the euro several weeks ago. Euro is most often the base currency as well. So if the yen, for example, is most often the quote. So if that one were to flip and be long, like if the yen were to be the strong currency, then we would probably go short on whatever currency pair option we had with the yen, if it were vice versa. But since it's not, we do want to be long on the currency that's against the yen. So we're still selling yen, but we want to be long on the instrument that allows us to basically short the yen, but we're still buying that currency pair. That may be kind of confusing. it'll come in time. If you didn't understand that concept, you will get it. It just takes some time to understand that. Okay, cool. So now let's kind of break down. The next thing I want to do is let's talk about how you take these trades. And then I want to talk about how you manage those trades, because I know that was one of the questions that came up. So now that we've figured out, this is basically the routine. Now that we've figured out what currency pairs we're going to trade, now we need to figure out how we're going to get into these trades. So the way I've traded this for years is I've taken these top 6 trades, and then what I do is I go out and put a stop loss in for all 6. Okay. Now, each currency pair is not created equal. They're not. And they need to have a different stop loss for each pair because each one has its own level of volatility. For example, the euro franc has a very low average daily range versus something like the pound yen, which has an extremely wide average daily range, right? So we have to adjust that to whatever we're working with. And so I was thinking, this is several years ago, I was thinking, how can I accommodate this? How can I create a stop loss that's unique to every pair that you're trading that also adjusts over time based off of market volatility? And that's where this site that I've used, and you guys are familiar with it, it's called mataf.net. It's right here. I'm going to put this link in the chat box for those that want it. I use their Forex volatility tool. As you can see, I use it all the time. That's why I have it bookmarked in my Chrome up here, because I use it all the time. So you can search whatever pair you want to trade. So if you're trading, for example, the dollar yen, which we are this week, you click on the dollar yen after you type it in, and then it's going to load up a metric here that you're going to be able to use. You're going to find the average daily range for each day of the week, which you can see here, Monday through Friday. And then what I do is I just pick the top day of the week. So it appears that Wednesdays has a 165.8 pip range. And I've been able, this has worked really well for me. Just use the average daily range, the largest average daily range that you see on here, as your stop loss for the entire week. And it works great. I've had a great success. It's been a good method, a very simple method. Just pick the average daily range, biggest one of the week, which it appears Wednesday is, and you just make that your stop loss. And it's 165.8 pips, which is a lot, right? But keep in mind, this is a week-long trade. It's a swing trade. Then what you'll do is after you do this, you can go in and put in your lot size calculator and find out, if you're going to risk 1% per trade, you figure out what 1% of your account is on 165 pips. And then that would be your risk. And so I'm always risking about 1% per trade. I've often told people, if you're doing a prop firm challenge, because there are losing weeks with the COT report, you may want to at least consider toning that down to 0.5% risk, just because there are losing weeks. And if you have unlimited time to pass, then you might as well do 0.5% to keep your account safe. Obviously, during the winning weeks, you're going to wish you did bigger lot sizes. Like this week has been good so far. But on the weeks that lose, you're going to be happy that you did a smaller contract size. We just don't know which weeks are going to win and which weeks are going to lose. We just don't know. But yeah, another thing that really helps to mitigate risk is I always use the trailing stop. And the trailing stop protects you in a lot of ways, because if that trade starts to go in your favor, you start to cut down that risk in the event that that trade were to go against you, which is really, really nice. So that's what I do for each pair, is I go find an individual stop loss for each one, and then I'll go place those trades, those top 6 trades, on Sunday when the market opens, or Monday when the market opens. And obviously I'll go and do a lot size calculation, which, by the way, let me just do that real quick because I did have some people ask me how to do that. So if this were me and I was trying to trade the dollar yen this week, if I wanted to buy the dollar yen and it's Sunday or Monday, here's what I would do. I would go to, let's go to the lot size calculator right here. This is with my FX book. This is the one I like to use. Everybody has their own. Some of them are on TradingView. There's some on MT4. I just use this one. It's just what I've always used and I like it. So I'm going to switch this to the dollar yen because I know I'm trading the dollar yen, right? And then let's say my account has $10,000, okay? And I want to risk 1% of my account on that $10,000 account. And I know my stop loss is 165 pips because I just figured that out right here. It tells me that the average daily range is 165 pips for the dollar yen. So now I come over here, put in 165, and then I just click calculate, and that's going to tell me what lot size I need. So 1% of my account is $100 because it's a $10,000 account, and I would need a 0.08 contract to accommodate this position. Okay. If your brokerage doesn't use contracts and it uses units, this is the unit you would need, is 8,327. And that's how you would do it for every single currency pair in that list on the COT report. And then you let the trade go after you put in a trailing stop. Now, the question earlier Lee had was how do you manage the trade throughout the week? So I don't do any like micromanagement throughout the week. So like I have on my app here, I'm actually looking at my trades here because I have an account specifically where I trade the COT report. I haven't done anything with the trades this week other than just let them sit. I did stop out on my USD CAD trade, which is this one right here. And when that stops out, I don't re-enter. Okay. Sometimes it's nice to re-enter. Other times I'm glad I don't. So I would rather just, if the trade doesn't work and the market's willing to go against me that far, I'm probably just wrong on that trade for the week. So I'd rather just stop out. So the USD CAD for me, that one did lose. And I think it did lose for most others, but that one I'm not going to re-enter. I call it a sunk cost on that particular trade for the week. And then I'm done. All my other trades, like every single trade I'm looking at it, all my trades are in the money right now. And that should be for most everybody that took these trades this week. Most of these have done very, very well. I actually, fun fact, took my first trade on the Mexican peso this week. And I told you guys this morning why I took a trade on the peso. It was based off of non-commercial information, which we can talk about again. But I don't do anything with these trades, Lee, during the week. Like I'm not going to close anything. Like if the market has news during the week, I don't close. I mean, if you feel the need to, you can. In fact, if you want to, like if it's a big news event, like a rate statement, if it's an FOMC meeting, a CPI, or like a non-farm payroll, I don't think there's any harm in closing maybe say half of your position or a quarter of your position the day before or a few hours before that news event comes out. I think there's no harm in that. But I've actually had plenty of news events that have made me quite a bit of money with the COT report. So and not every news event's going to do that either. There have been plenty of news events where they've caught me behind my tail, and other news events where it's been like, I've been pretty grateful that I was trading during those news events. So I'm going to leave that one up to you. If you want, like if there's a big news event coming up, you can decide what you want to do. Maybe ask me some more specific questions. I'm just kind of answering in general, but if you have other questions specifically, I'd be more than happy to answer those. But during the week, I don't really close unless, like I said, if it's a major news event, like a highly anticipated rate statement, maybe close half just so that you could lock in what you have. But at the same time, there have been plenty of news events that have worked in the direction of the COT report. So, do I use a trailing stop? Oh, absolutely. Yeah, absolutely use a trailing stop. I think it's a must. So something we talked about this morning, Lee, I don't know if you were here this morning, I can't remember, but something this morning we talked about was last week, it was a losing week for the COT report. Had you not used a trailing stop, these trades would have lost you, these top 6 from last week would have lost you 372 pips. However, had you used a trailing stop, the results would have been minus 34. So you still would have lost money last week, but you would have only lost 34 pips in comparison to, 372 minus 372. So definitely worth using definitely worth using a trailing stop for sure. And the way that looks is, I don't know if you've ever used one before, but there's a couple of ways you can do that. On MT4, the way you can enable a trailing stop is you have to take the trade first. Okay, like normal, let's say you're going to buy the dollar yen start of the week like we did this week. You have to take the trade and then place your stop loss as you can place your stop loss as you're taking the trade, the 165 pips. Once it's placed, you go to your order screen and then you right click where it says stop loss. And then it will give you an option to enable a trailing stop there in the drop down. Like in the pop-up window, you can enable the trailing stop, which is really important to do. I also trade on Owanda. That's where I do a lot. That's where I keep a lot of my personal money. And when I'm trading on Owanda, I just what I do is you pull up the new order window, you put in your stop loss, and then they have just below that in the order window on Owanda, it says trailing stop. And I just put in the same amount for my trailing stop. So I'll put in like 165 pip stop loss on the dollar yen, and then I'll put in a 165 pip trailing stop, and then it will move up, which is pretty cool. So yeah, it's pretty awesome. But basically, here's how they work for those that don't know how they work. I'm assuming you do. If you don't, that's fine. And for those of you watching the recording, this is also for you. So here's how they work. So our best trade of the week right now is this NZD JPY. This trade has done quite well for us. I've been very pleased to see the results with this trade. So we got a signal to buy the dollar NZD JPY on over the weekend, and this was the weekend right here, this yellow area. So the start of the week was right here at the beginning of the yellow, and we got a signal right there to buy, and it has gone in our favor. At one point today, we were up about 216 pips on this trade. Okay. At the moment, we are up 180, just over 180 pips. Okay, so it's pulled back just a little bit. So this trade, I can't remember what the stop loss was. Let me actually see. You can just go here to find out what it was. You just search the currency pair you're trading, say the NZD JPY, and then you just wait for it to load up. Pick the biggest day of the week. Okay, that's 109. 109 pips is my stop loss on the NZD JPY. So when I am over here, my stop loss originally, when I took this trade, I bought 109 pips below this. So 109 pips would be about right there. So that's where my stop loss was when I first bought. And this is where I bought. It's right there. So that was my trade. I didn't even use a take profit. So that's another thing too, by the way, for those that are new, we do not use a take profit. Yeah, crazy, right? We do not use a take profit on this strategy. It's a time target. So your take profit is basically just close on Friday around lunchtime, and you can determine what your routine is going to be. But basically just make sure you close all your trades before the weekend And that's generally how that works, is you're just going to close before the weekend, right? So let me finish explaining how this trailing stop works. So with this trade, I took it right here on Sunday, and this trade basically immediately started marching in our favor. Okay. And this thing moved up, we'll just say right here, it moved up 50 pips in my favor. So my trailing stop is going to also move up 15 pips, and this will happen automatically, 50 pips, right? And at one point, this trailing stop, because it went from here all the way to here, at one point today, I was up 210 pips or so. Okay, since my stop loss was about 106, that means at one point this trade was in the money like 103 pips or something like that. So from where I entered, maybe just a little bit more. So I'm assuming my stop loss is around right here. That's probably where my stop loss is at this point. So no matter what happens at this point, this trade can't lose money. It can only lose what it's made, because if it pulls back, it's going to close me out right here. But my entry was down here, so I will be making money on this trade, which is kind of cool, no matter what happens. One other thing to note: this is as high as the market got today. It's right up here, and the trailing stop got up to here. But when the market pulled back, the trailing stop did not go backwards. The trailing stop isn't allowed to go backwards. It's allowed to only march forward as the market marches in your favor. But if it starts to pull back, he just stays right there. He doesn't, he just stays at the spot where he had the most progression. So this is where he had the most progression in the trade, was when the market got up to this point, and that's where the trailing stop said, yep, I'm going to stay there. And then it pulls back, the market pulls back, and he just stays there. So if this market continues to fall from its pullback this afternoon and goes to here, I'll close for profit, but the trade will be over. Okay, at that point. Okay. Now, if this trade decides sometime tonight to continue higher, as that continues higher, this and goes above where it got to the highest point right here, anything above that higher point is going to start dragging this trailing stop up a little bit more proportionally. Okay, it's going to continue to go up, right? And then the market, will be right there. And if it pulls back at that point and hits my stop loss, then I'm out right there. Okay, that's how a trailing stop works. It's pretty genius. It's awesome, especially for a swing trades. I think they're especially awesome. I think trailing stops are pretty terrible for scalp trading. And the reason why they're not good for scalp trading is because usually when you're scalp trading, the trade has a tight stop loss to begin with. These aren't really tight. Like, these are 100 pip stop losses, or, some of them have 80 pip stop losses. Some of them have 150 pip stop losses. So they're pretty wide stop losses. So, you do want to cut that risk down as soon as the market starts to move in your favor. Okay. Let's see. So is your trailing stop the same amount as the actual stop loss? Don't you have to put in a value for trailing stop? Yeah. So it's the same value when you're putting it in. So when I'm putting it in on a Wanda, it's the same value. When you're doing it on MT4, you're just going to right click on your stop loss. So with the dollar yen, let's say it's 165 pips. You're just going to right click on your order stop loss, and then it will have a pop-up window where you can add a trailing stop, and it will then just take care of that for you. Okay. Yeah, I'm going to answer Bill's question, and if you have more questions, let me know. Bill says, can you go over the difference between with reading pips with the JPY versus other currencies. I can to some extent, Bill. Honestly, I'm gonna be honest on this. I'm not the biggest pro on knowing the difference in pips between each one. It's still like it's elusive to me. And the other thing too is I haven't really needed to know the difference because I have a lot size calculator that does the difference for me. So for example, let's do an example of something real quick. So let's say I'm going to take a trade that has a 100 pip stop loss on the dollar yen, and I put in a $10,000, let's do $100,000 account, risking 1%, and I click calculate. It's a weird lot size. Like it wants 1.37. But if I change the currency pair to something like the euro dollar, I already know what's going to be. It's just going to say one contract, or it should just say about one. Yeah, there it is. It says one lot. Okay. So, and then when you go to the um and then when you go to the dollar yen, it changes that to, or the NZD JPY, it's now 1.37. So I'm not exactly sure how that works, but it looks like you have another question here. It says I was referring to more which decimal is one pip. Oh, I gotcha. So it actually depends. It is an anomaly. So when you're looking at the dollar yen, so this is the NZD JPY. This is basically saying there's 87, or like we're at 85.14, 85.814. Don't quote me on this, but I'm pretty sure what that means is there's 85 kiwis to, or no, excuse me, 85 yen to one kiwi. There's 85 yen. And then if you pull up something like the pound yen, you've got, it's a much bigger number. It's like 171. That's 171 yen to 1 pound. So that's why it's not consistent or cohesive across multiple different currency pairs. It's not cohesive because every currency has a value that could be way more or way less than the yen. Like the pound has a value that's way more than the Japanese yen. And so that's why you have such a high number with a decimal that's 3 spots over, versus with the NZD yen, NZD, the Kiwi is not worth as much as the pound. So, but it's still, the Kiwi is still worth way more than the yen is. And so that's why there's still 85 yens to one Kiwi, right? If you look at, let's see, let's do the dollar yen. So yeah, there's 137 yens to $1, right? And that's why the decimal's placed where it is, because there's that many yens to one US dollar. Okay. When you look at like the euro dollar, it has historically been, it used to be a much higher number, but now it's much closer to 1-to-1. In fact, last year there was a point where it was €1 to $1 for a little bit. Let's do the peso. Like this is one I've been trading recently. There is like basically a peso, a Mexican peso is basically a nickel. That's what a peso is, and it takes about 20 pesos to $1, right? That's what this is saying right here. That's why it's 0.05700 or whatever it is. That's what these numbers are trying to tell you, is the parity between one currency to the other. And if you think about it, one last thought, and it looks like you're getting it, but one last thought. The yen is like that one major currency in the world that's like super inflated compared to the rest of the currencies. Like if you think about the CAD, the Kiwi, the Aussie, the pound, all of those currencies are pretty close to each other in terms of like their parities. They're not too far off, right? There's some of them are still like 20, 30% off from each other. But like you look at the Japanese yen and they're hundreds and hundreds of percent off, right? Because there's 137 yen to $1. There isn't 137 Australian dollars to $1. It doesn't work like that, right? And so that's why it's super weird with the yen, but I'm glad it makes sense. Let's see, Lee says, do you put the trailing stop in units or pips? So if it's 100 pip stop loss, do you enter 100 or would you enter 1,000? Also, does your computer always have to be active to use a trailing stop? So on MT4, they also include the tick. So that's why you have to do 1,000 if it's going to be 100 pips. If you did 10,000, that would be 1,000 pips and so on. So like if you just did a 10 pip, if you just put 10 in MT4, it would only be a 1 pip stop loss. And if you did a 100, if you put 100 in MT4, it's confusing. I know, you just have to know the difference, right? That's only a 10 pip stop loss. So yeah, 1,000 would be a 100 pip stop loss. I know it's confusing, but that's how MT4 is. In Owanda, it's not like that. Like that's where I do a lot of my trading. It's not like that. So all right, guys. Well, I think that covers most of everything that we needed to talk about today. Very productive. I appreciate your attendance and your comments and questions. That's always appreciated. And I hope this was helpful. I'll have this recording up here in just a few moments, but I appreciate you guys coming today. Thanks for coming, and we'll see you in the next webinar.